Understanding market bubbles. Imagine your savings suddenly lose 90% of their value, not because you made a mistake, but because the market got ahead of itself. This terrifying event has happened twice in the last century, and according to Ray Dalio, one of the world's most respected investors, we are marching down that road again. But here's the most confusing part of his warning. He also says you shouldn't panic and sell everything. Right now, markets are at all-time highs. AI stocks have been on an incredible run, and there's this ongoing debate about whether we're in a bubble. But here's what most people get wrong. Being in a bubble doesn't automatically mean you should sell. In fact, some of history's biggest gains happened right before bubbles burst. Now, before you start imagining actual soap bubbles, let me explain what this means in the simplest way possible. Hey everyone, welcome back to Fedah Signals. I'm Fedah, and my goal is to break down money terms so you avoid getting lost in the hype, headlines, or shifting market sentiment. Today, we're tackling the word market bubble, and I promise to explain it so clearly it'll be easy to follow. By the end of this video, you'll understand what a market bubble is, how experts measure if we're in one, why these bubbles pop, and why cash is the key, and what this all means for your day-to-day finances and long-term investing. Remember, principles don't change, sentiment does. Everything here is for education and entertainment only. Always talk to a licensed professional for personal financial advice. Now let's focus on the principles. What is a market bubble fundamentally? It's when price and value completely break up. Think about Sarah's lemonade stand. She makes $10 a day. But people get so excited about the potential of her stand that they start trading tiny pieces of the business for ridiculous amounts. Soon, people are valuing the whole stand at $5,000, 50 times more than what it earns in a whole year. That, my friends, is a bubble. It's when the belief in future potential becomes completely untethered from current reality. We saw this in the 1920s with Radio Corporation of America, or RCA. Radio was the dazzling new tech. People paid nearly $500 per share for a company that was only earning about $11 per share annually. They bought because they assumed the price would keep going up, not because the underlying earnings justified the cost. These were great companies, just like many are today, but their prices hit unsustainable heights. According to Dalio, the danger isn't the high price itself, it's the unsustainable conditions, the buying spree and the sky-high valuation that simply can't last forever. So how do smart investors like Ray Dalio figure out if we're in a bubble? Well, Dalio created something he calls a bubble indicator that he's been tracking markets since 1910. Think of it like a thermometer for the stock market. It tells you if things are getting too hot. Here are the 6 things Dalio looks for. Are prices really high compared to what companies actually earn? Think back to Sarah's lemonade stand. If she makes $10 a day, but someone says the stand is worth $10,000, that's a warning sign. Are people expecting prices to keep going up forever? It's like if everyone assumes Sarah would soon be selling 1,000 cups of lemonade a day, even though she only has time to make 50 cups. That's not realistic. Are lots of new people jumping in who've never invested before? In 1929, the saying was that everyone from banking and industrial magnates to chauffeurs and cooks were buying stocks. When your barber and your Uber driver are giving you stock tips, that's historically been a red flag. Are everyone super excited and optimistic? When everyone thinks stocks only go up, that's when things get dangerous. Are people borrowing money to buy stocks? In 1928 and 1929, people were buying stocks with only 10% of their own money, borrowing the rest from brokers. That's like buying a $100 toy with $10 of your allowance and $90 borrowed from your parents. Are companies spending huge amounts of money expecting business to keep booming? This measures whether businesses are building factories and buying equipment like demand will keep growing forever. Dalio's recent reading puts us at that worrying 80% mark. This means most of those 6 conditions are strongly present. In the 1929 and 2000 crashes, this gauge hit 100%. Think of it, the balloon is not popped, but it is definitely full. The psychology of the crash, strong hands versus weak hands. This next concept is the most important lesson for managing your risk. Strong hands versus weak hands. Imagine you're at a birthday party and there's a game where everyone holds balloons. Some kids are holding their own balloons that their parents bought them. They can hold on as long as they want. But some kids are holding balloons they borrowed from others and they have to give them back in 10 minutes or their parents will be mad. When someone yells, "The balloon popping contest starts now," guess which kids panic and let go first? The ones who borrowed the balloons and don't want to get in trouble. Strong hands are the kids who own their balloons. They're investing with their own money for the long term. They can sit out the drama. Weak hands are the kids who borrowed the balloons, often using leverage. They have to give them back soon, or they face consequences. In the market, weak hands are retail investors buying on borrowed money or hype. When prices dip, weak hands get scared, or worse, get forced to sell by their lender. Dalio noted that wealth is highly concentrated today. This means if one big group of weak hands is forced to sell, it creates a massive supply of stock, driving prices down for everyone. It's not 100 people dropping one balloon each. It's one leveraged player being forced to drop 100 balloons at once. That forced selling is the real mechanism of a crash. Why does the crash happen? It boils down to one simple, unavoidable truth: liquidity. You cannot spend stocks or houses or Bitcoin at the grocery store. You need actual cash. Dalio explained that bubbles don't pop because estimates were wrong. They pop because of the need for cash. When many people suddenly need cash, maybe to pay unexpected bills, or if the central bank makes borrowing costs much higher, they all rush to convert their paper wealth into real cash. When everyone tries to sell their assets at the same time, the limited cash in the system can't absorb the flood of selling. That's when prices crash. The gift card that was worth $100 suddenly sells for $5 just to get the few real dollars necessary. So here's the bottom line, and a personal opinion. The smartest thing you can do is not panic, but get informed. Stay aware, not scared. The 80% warning is about risk, not a prediction. Think of it like a weather forecast saying 80% chance of rain. You don't cancel your whole life, or you bring an umbrella. Focus on the long term. If you pay too much for stocks today, the math says it's very hard to earn a high return over the next decade. As a long-term investor, you want to buy things that are cheap, not things that are popular. Don't borrow money to invest. Keep cash available. Having some cash saved means you have options when prices drop. While the weak hands are being forced to sell, you can use your strong hand cash to buy great companies on sale. Yes, by historical measures, market conditions look stretched, but our Fedah Signals principle is simple. Principles don't change, sentiment does. Stick to your principles. What do you think? Are you worried about bubble conditions, or do you think things are different this time? Drop a comment below. I love hearing your thoughts. If this helped you understand bubbles better, hit that like button and subscribe for more videos. Thanks for watching, and remember, stay curious, stay informed, and don't believe anyone who says investing is easy or that they're absolute about the future.